Dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. In the last lecture, we discussed adjusting entries and the types of adjusting entries, and we covered the two types of adjusting entries. The first was converting assets to expenses, and the second was converting liabilities to revenue. And now, this lecture is only the continuation of the previous lecture, where we discussed the third and the fourth types of adjusting entries. Okay, dear students, look here. In the third one, we have entries to record unrecorded expenses, accruing unpaid expenses. What does this mean? This means in some situations, businesses, they do expenses but they do not pay it. For example, it's the end of the accounting period, the end of January 31st, and the company is about to pay the salaries, but the company postponed the salaries into the next month. Or it's to pay the rent, but the company planning to pay it in the next month. Or the taxes, sometimes they differ the taxes, right? So and this is quite normal in businesses. Expenses incurred but not yet recorded. So dear students, in this type of adjusting entries, you learn that assume if the company or any business, if is not paying the expenses of any particular period, right, then the company should record it. The company should not think, or anyone should not think, that I'm paying this expense late, so I will record it late in another month. It's wrong, it's incorrect. Why? Because we have learned that you cannot record the expenses of one period in another period. Similarly, you cannot record the revenue of one period in another period. Why? Because if you record the revenue of one period in another, or expense in another, you are overstating either the revenue or the expenses. So if you increase the expenses or overstating the expenses of one period, it means you are understating the expenses of another period, and that is wrong. That is against the matching principle. And what's the problem here? The problem is that if you are showing the expenses higher in one period mistakenly, it means you are reducing the profitability of that particular period, and that will mislead the reader, the stakeholder, the shareholder, and everybody is misled. So that is why in adjusting entries, we learn that a company must apportion or record the revenue and the expenses of the period in its own period. Okay, so in this one, the third one, we learn that if expenses incurred in a business, but a company or a business is planning to pay it in another period, so no problem, but to record it now must be recorded. And that is the concept of the accrual, to record the expenses irrespective of the payment. Okay, so what we have here, January 31st, salaries due to the employees 20,000 postponed to the February 28th. Okay, it means a company here in this example should pay the salaries 20,000 because it is January 31st, the time of the salaries, right? But because of some reason, the company is postponing, right, delaying the salary into February 28th. Okay, now you should record the expenses in the January. Don't say I will record it in the February because I'm not paying. No, expense incurred, recorded, no matter if you are not paying it. So that is why what we are doing here, on January 31st, you have to debit salaries expense should be debited, right? And what should be credited? Salaries payable. Okay, salaries payable. Okay, salaries expense 20,000 and salaries payable 20,000. Okay, dear students, at February 28th, now it is the time to pay the salaries. But one point here, at 28th February, the salary of February is paid, and also the salary of the January is also paid. So you should write salaries expense of the February debit, and also the salaries payable expense liability should be debited, and cash should be credited. Look here, so the salaries expense should be debited for February 20,000, and also the liability of the January should be reduced, and the cash should be paid decrease how much? 40,000. Dear students, look here. Salaries expense increased for the February, and also the liability of the previous month decreased. That's why debited, and cash we are paying, so credited. It's meaning 40,000 cash paid in the February, 20,000 that is the expense salary of the February, and 20,000 that is the liability of the previous month we have recorded. So I hope you learned. Now in another example, January 1st borrowed short-term loan $10,000 for 10% annual interest for 3 months. Okay, dear students, here you are borrowing what? A loan, $10,000, and how much interest you are paying on this 10%? For 3 months you have borrowed. Now keep in mind, the money you have borrowed, you have to pay interest, and the interest is your expense. Okay, now right now at January 1st you have borrowed, so you have to record simple general journal entry because you have borrowed loan. So you should debit cash, and you should credit notes payable account. So cash debited how much? $10,000, and $10,000 account notes payable credited. Increase in asset debited, increase in liability credited. Now after 1 month you have used the money you have borrowed, you have used. Now what happened? Expense incurred. Money is not for free. The bank is not lending money for free. You have taken a loan. Now you have to pay the interest of the January. How much? 10%. But you are not paying it now, but it is the expense of now, this month. So you should record it. What? Interest expense debit, and interest payable credit. But how much interest expense? If the loan is $10,000, so the interest of 1 year, 10% is 1,000, and now find out 1 month. So 1,000 equals sign 1,000, which is 1 year interest divided by 12. So in 1 month it is 83.3. Clear? So dear students, after 1 month, January 31st, expense incurred how much? 83.33. So debit, and also that turns out liability. You're not paying it, you are paying it, you will pay it in the future after 3 months. The same transaction should be recorded at February 28th. Okay, I hope you have learned here. So this was the third entry, right? The third types of adjusting entries, where you have learned how to record unpaid expenses, or how to record unrecorded expenses. Now we are going into the fourth type. Okay, what is in the fourth types? We have accruing uncollected revenues, or in other words, record unrecorded revenue or uncollected revenue. Dear students, it's quite normal in businesses. They provide services, right, and they receive the cash in future. For example, I'm a teacher, right? I'm just providing a tuition for 3 months. So I'm just telling you, right, that I will provide you services, right? I will teach you accounting for 3 months, and you have to pay me at the end. Look, I'm giving service, but I'm demanding at the end. And sometimes in projects happening like this. So you do the contract to provide the services and receive the cash at the end. Okay, now for example, in this question we have ABC contracted to provide services for 2 months, January and February. ABC company did a contract to provide services for how much? For January and February. How much? $6,000. This can be any service, maybe renting, right? Giving apartment for rent, maybe teaching, maybe any other service, hoteling service or any other service. Now how much to be received at the end of the completion of the service? $6,000. Okay, now the contract is happening at January 01. Now after 1 month, it's been at January 31st. As per the contract, you have provided the services. Okay, why? Because you are providing the services for 2 months. After 1 month, you have provided the services, so you should debit account receivable, right? And you have to credit what? Service revenue. This is service, right? How much? 3,000, right? 3,000. Why 3,000? Because students, because here is $6,000 you have contracted. 1 month service you have provided, then you have earned how much? 3,000. So you are not yet receiving, so you are debiting account receivable, increase in asset, and your revenue increases. This is what we mean by adjusting entry, to record the expenses, to record the revenue you have earned but you have not received, like this one. Now what is happening at February? At February you are receiving all of the money. It means your services are completed because you have contracted to provide services for 2 months. Now it is the end of February 28, right? Then it means you are receiving cash. So cash debited how much? $6,000. And also what should be debited? Cash debited $6,000. And what should be credited? Account receivable. Account receivable, right? How much? 3,000. And what else should be credited? Service revenue, right? How much? 3,000. Look, dear students, so much easy. You have received cash. How much cash you have received? $6,000. Okay, and 3,000 in this 6,000, this was the collection of the receivable from the previous month, and 3,000, this is the revenue of the February. Clear? So this is the second adjusting entry you have to record. Okay, now we go into the January 1st. Another entry we have example. ABC lent money $10,000 for 10% annual interest for 3 months. Okay, now we have ABC lent money. Okay, in a previous example, money borrowed, but here the money is lent. ABC lent money how much? $10,000, right, for 10% interest. But how much is the duration here now? 3 months. Okay, ABC is lending money and how much? 10,000 for 10% interest. Okay, keep in mind why we are lending money. The purpose behind is to earn interest, right? Okay, so now when you lend money, you are earning interest when the money is used by other. So maybe after 1 month you will earn interest, right? So for example, after 1 month you have earned interest because your money is used by someone who is giving you interest. So how much interest you have earned? So you should debit interest receivable, right? How much? Easy, same. And $10,000 for 1 year, the interest is 1,000. And for 1 month, so 1,000 divided by 12. It's mean 83.33. And then you have to credit what? Interest revenue. Okay, so how much? 83.33. Dear students, you have lent money for the purpose to earn interest. but after 1 month the money is just earning for you. So you have earned the interest, but you have not yet received. As per the contract, you may receive the interest at the end when you collect your receivable at the end. Okay, so that is why you have lent. So ABC lent money at $10,000. So I'm just here directly recording the entry of January 31st for interest. But if you want to record this, the first transaction, because January 1st you are lending money, so what you should do, January 1st, okay, when you lend money, what is debited? Notes receivable. And what is credited? You are paying cash. Okay, so if you record the first transaction, so note receivable debited because you are lending money, and that is how much? $10,000. And cash credited how much? $10,000. So why note receivable debited? Because it is increase in asset. And why cash credited? Because it is decrease in assets. Okay, now the money you have lent is earning for you. That is the entry, the adjusting entry. This one is actually not the adjusting entry. This is the general journal entry. Okay, now what is adjusting entry? After 1 month you are earning interest. How much is interest? Interest expense debit, sorry, interest receivable debit, and interest revenue credit. Okay, how much interest receivable? 1 year interest is 1,000, right? So 1,000 divided by 12, so 83.33 in equal sign. Okay, now look here, dear students, let me conclude it here. ABC lent money $10,000 for 10% annual interest. So you are lending money. So what debited here? Note receivable account debited, because increase in asset should be debited, and here you are paying cash, so a cash account credited. Now after 1 month, the money you have lent is earning for you. How much? 10%. Okay, 10% is for one year, and then divided for 1 month divided by 12. That means you are earning in 1 month this much interest, but you have not yet received it, and you will receive it in the future. So dear students, this second one is actually adjusting entry. And which one is adjusted? The entry which is recorded at the end of the period, that is called what? Adjusting entry, right? So I hope you have learned, and this was all about adjusting entries. The types of adjusting entries we have covered. The first one is to convert asset to expenses. The second is to convert liabilities to revenue. The third is to record unrecorded expenses, and the fourth one is to record unrecorded revenue, or you can say accrued revenue, uncollected revenue. Okay, so if you have any question, you can ask me in group, and inshallah I will explain it to you. Allah Hafiz. Assalamu alaikum.